Wall Street deployed every weapon it owns this week: margin hikes, algorithmic sell-offs, coordinated bearish research, and a media cycle built entirely around one word: crash. Friday, March 6th, New York time. Comment your date below so I can see where you're watching from. If you value this work, subscribe and comment George Williams. It really helps. Right now, COMEX silver is printing around $80 to $81 an ounce, down another 2.57% on the day. The daily range ran from $80.66 to $85.73. CPM Group has a $68 target on the board. JP Morgan is warning about 50. The gold to silver ratio, which sat at 45 to 1 back in January, has ballooned to 64 to 1 today. A number the bearish crowd is waving like a flag as proof the silver rally was nothing but speculative froth that has finally, inevitably collapsed. The correction from the all-time high of $121.67, set on January 29th, now stands at 33%. Year to date, silver is still up somewhere between 19 and 25% depending on your entry, but that context disappears entirely in the crash coverage. The narrative has been written. The bubble burst. Get out before it gets worse. That is their story. Here is what they are leaving out. When the paper price touched $80.66 on Thursday, not a single physical silver dealer in the United States, the United Kingdom, or Europe was selling at that price. American silver eagles were changing hands between $84 and $93 an ounce. The real transaction price for real metal, the price where an actual buyer and an actual seller complete an actual exchange, never touched the number your brokerage screen was showing. Meanwhile, in Shanghai, physical silver premiums are running $20 to $25 over Western spot. That puts real transaction prices on the Shanghai Gold Exchange at somewhere between $100 and $106 an ounce, while the Western paper price screams 81. Two prices, one metal. The price where paper contracts trade and the price where physical metal moves have split apart in a way that cannot be explained by normal market behavior. It can only be explained by a paper market that has become increasingly disconnected from the physical reality it is supposed to represent. Now here is the COMEX delivery data, and this is the number that should be on the front page of every financial publication on the planet. March delivery has already hit 52.63 million ounces. 48.3% of standing contracts were delivered early. A record 43.1% delivered on the very first notice day. In a single recent session, 2.4 million ounces of physical silver left COMEX vaults. Brinks alone saw 1.2 million ounces depart in one day. Think carefully about what this behavior reveals. The institutions demanding physical delivery from COMEX are not retail investors panicking. These are sophisticated market participants with legal teams, vault infrastructure, and the operational capacity to take and store large quantities of physical metal. They are exercising their contractual right to receive actual silver bars from the exchange system at the fastest rate in COMEX history. If silver were genuinely heading to $68 or $50, not one of those institutions would be demanding delivery at 81. They would take cash settlement today and buy cheaper metal next month. The fact that they are demanding physical now, at this price, at this volume, is a direct expression of what they actually believe about where this metal is going. And it is the precise opposite of what the bearish research is telling you. The supply picture is where the crash narrative becomes most dishonest by omission. Since 2021, the global silver market has consumed 820 million ounces more than it has produced. 5 consecutive years of deficit. 2026 is locked in as the sixth, with the Silver Institute projecting a minimum shortfall of 67 million ounces this year alone. The cumulative total approaches 900 million ounces by year-end, essentially an entire year of global mine production that has been permanently consumed, embedded in solar panels, defense electronics, medical devices, and industrial applications that do not get recycled. The recycling rate has fallen to 17.8%, a 4-year low. Scrap dealers are hoarding 40% more material than usual because they expect higher prices ahead. No new significant mine capacity comes online until 2027. And starting April 1st, India's new collateral policy will lock up an additional 80,000 tons of secondary supply, removing a meaningful chunk of floating inventory from the accessible market. Not one mainstream crash narrative published this week mentioned the cumulative deficit. Not one. Because mentioning it would require explaining how silver reaches $50 when 5 years of global consumption have exceeded production by nearly 1 billion ounces. That explanation does not exist, so the deficit simply disappears from the coverage. The conflict of interest at the center of this week's bearish campaign is documented in public records, and it is worth stating plainly. JP Morgan, which is warning you that silver could fall to $50, paid $920 million in September 2020 to settle Department of Justice charges for manipulating the COMEX silver and gold markets over an 8-year period. The concentrated short position in COMEX silver futures currently stands at approximately 40,000 contracts, representing around 200 million ounces. A short position of that size cannot be closed without buying silver. Every dollar the price falls before those shorts are covered is a dollar saved. Every retail holder who sells their physical metal, their ETF shares, or their mining position adds supply to the market. Supply that can be absorbed by the short sellers as they quietly exit without triggering the price explosion that covering 200 million ounces of shorts would otherwise produce. COMEX lease rates are currently running 6 to 8% annually, which means the cost of maintaining that short position is bleeding millions of dollars per day. The clock is running on the short side. The bearish research, the $68 targets, the $50 warnings, they serve a specific mechanical purpose. They are not market analysis. They are exit strategy. Now the risks, because intellectual honesty requires them, and because the bull case is weakened, not strengthened, by pretending the headwinds are not real. The dollar index at 99.2 is pressing toward 100. If DXY breaks above that level and holds, it creates sustained downward pressure on dollar-denominated commodities, including silver. The 10-year Treasury yield at 4.10% raises the opportunity cost of holding a non-yielding asset, and if the Federal Open Market Committee delivers a hawkish signal on March 18th, that yield could climb further, and the dollar could accelerate toward parity. The VIX at 23.57 reflects genuine risk-off sentiment in equity markets, and in a broad deleveraging event, silver gets sold alongside everything else regardless of its fundamentals. If the Iran situation de-escalates rapidly, which is possible and not being priced as the base case, the war premium embedded in the current silver price evaporates quickly, and that likely represents $5 to $8 of downside on its own. Solar thrifting is a legitimate multi-year headwind. Manufacturers are reducing silver intensity per panel and experimenting with copper and cadmium telluride substitutes, which over time compresses one of silver's largest demand categories. These are real forces. They do not disappear because the bull case is compelling. But here is where the forward picture gets structurally interesting. The paper-to-physical price divergence currently running $20 to $25 on the SGE is not sustainable in one direction indefinitely. Either the physical market corrects down toward the paper price, which would require a destruction of physical demand that is not currently happening in India, Shanghai, or at a single US dealer, or the paper price is forced upward toward the physical reality. If the COMEX drain continues at its current pace, the registered silver available for delivery shrinks toward levels that make the existing short position mechanically impossible to maintain. At that point, covering 40,000 short contracts against a thinning deliverable supply base creates the conditions for a disorderly repricing. Not a prediction, but a mechanical description of what happens when a 200 million ounce short position attempts to close into a market where physical availability is declining and Eastern buyers are paying $25 over spot. The lease rate at 6 to 8% is already signaling that borrowing silver to maintain short exposure is expensive and getting more so. Each week the drain continues, that cost rises. The India April 1st supply lock adds a specific, datable catalyst to the supply picture. When 80,000 tons of secondary silver is removed from accessible floating supply on a single regulatory date, the pool of metal available to satisfy physical demand contracts sharply. If that coincides with continued COMEX drain and persistent Shanghai premiums, the gap between paper and physical widens further, and the pressure on the paper pricing mechanism increases from below. Over the next 30 days, the bear scenario looks like this. The dollar breaks above 100. The Fed signals no cuts before the fourth quarter on March 18th. Iran's ceasefire talks gain traction, and ETF holders in the West continue liquidating. In that environment, COMEX silver tests $75 to $78, the gold-to-silver ratio pushes towards 70, and the paper price remains disconnected from physical reality for longer than most bulls are prepared for. That is a real possibility, and it would be painful for anyone holding leveraged positions. The bull scenario over the same 30 to 90-day window looks like this. The COMEX registered inventory falls below 300 million ounces under continued delivery pressure. Lease rates climb above 10%, signaling acute stress in the lending market. The India collateral policy locks up secondary supply as scheduled on April 1st, and one or both of the G20 central banks reported to be initiating silver purchase programs, including Russia's ongoing accumulation toward $535 million, makes a public announcement. In that sequence, the paper-to-physical divergence becomes publicly undeniable, Western ETF outflows reverse, and the short position faces covering pressure into a market where the metal is already being held tightly by institutions that took delivery at 81 because they believed it was cheap. In that environment, the path back toward $100 is not a prediction. It is the arithmetic of a short squeeze in a structurally undersupplied market. Two prices exist for silver right now. One is what derivatives traders see on a screen controlled partly by entities with 200 million ounces short and a criminal conviction for manipulating that screen. The other is what physical buyers in Shanghai, Mumbai, and every coin dealer in America are actually paying today. Markets eventually converge on reality.